We also have Mayuresh Joshi joining us on the show. Before I come to you, Mayuresh, let me take it to Naresh and get his view on one of the sectors that everyone was touting to be the leader going ahead, and that has to be the FMCG index. Mayuresh, I beg your pardon, Naresh, given the fact that FMCG index is seeing a decline for a 14th consecutive session, correct me if I'm wrong, and I believe this is a record losing streak coming in for the sector. Given the fact that on February 1st, when the announcement came in for the budget, this one actually saw a good spike of about 3%.
So it's been a very sharp cut in Nifty FMCG and the whole FMCG stocks. But now it is interesting because the stock prices have corrected sharply and they're back to the prices where they were in the mid of 2023. A lot of stocks like Dabur are back to the prices they were 6 years back. You have Godrej Consumer, which has taken a large knock and has started seeing a bounce back today. So Godrej Consumer is at the same price where it was back in 2021. So I think there could be selective opportunities across the board. And now from here on, buying on this dip would imply it could act as a defensive portfolio pick for you. So for now, Godrej Consumer looks interesting at current levels. Then similarly, Hindustan Unilever closer to 2100 could be a good entry price. Dabur at current level looks like a good pick going forward.
Right. Mayuresh, what is it that you're making of the market right now? It's been sedate today, at least for the index. But what about the constituents? Because if I look at some of the key large caps, the likes of a Maruti, HDFC Bank, Bharti, ITC, Kotak Bank, they're not participating in today's market. They're all down. Mayuresh, what's your view on the market?
That's for me, Aisha? Sorry.
Yes, that's for you. Okay, we seem to be getting a little bit of a disconnect with Mayuresh. We'll just get back to him. But Kunal, to you, the constituents of the Nifty Bank, ICICI Bank, HDFC Bank, Kotak, all of them down. What are you making of the moves here?
Yeah, difficult to comprehend that what's actually going on. This could be maybe a shuffling which could be going on. Traders were positioned on the positive side for these stocks for a point when the markets were into a rough patch. So maybe a buy on defensives, so-called large cap names could have been the strategy. And now there could be a possibility that the money is shifting back again into these high beta pockets or the ones which have been beaten down because maybe the valuations, technicals, etc. could have started to look attractive into this pocket. But I think this could just be a temporary shift which could be happening. What we need to see is that if in case over the next 2 or 3 days, you see these large cap stocks making a comeback, that would help the Nifty propel back again above that 23,000 mark. And that's going to ooze the confidence a lot more further for the markets.
Right, that's a take coming in some of the banking names. Mayuresh, I hope you can hear us now. And like Aisha was asking you, what exactly should one make of this market, given the fact that now we're seeing some sort of a semblance actually creep in? But given the fact that the way how the market has been trading a bit of a range bound over the last 2 to 3 trading session, how should one actually strategize for the future? What should the strategy be given the fact the large part of correction is already done for the SMIDs?
Oh, afternoon to you as well. I think we've just recently published a few data points which are sounding a little bit more optimistic as we speak. So we've actually done 3-4 analysis. One, I think in terms of the bond yield and the Nifty earnings yield, this has largely contracted and this has come down to around 1.8, 1.9 in terms of the spread that between the earnings yield and the bond yield. And once it crosses 2, I think a large part of the move probably gets gestated. So very, very close to that. So either we are very, very close to forming a bottom or the expectation of the market that the earnings downgrades should largely be over as we hit Q4 or Q1. So that's one parameter where over the last few years we've seen that has worked well in favor of the markets. The second element is in the entire Nifty 500 universe, there are only 15 stocks or 15 percentage stocks which are probably trading above the 200-day moving average. Now, if you've seen in the historical past, whether you go to 2008, whether you go to 2014, or even the COVID crash, when such a scenario happens, I think the next few weeks or the next few months or the next few days, depending on the time horizon, I think the market usually bottoms out. The third parameter that we're looking is the dollar index. Obviously, it had capped out at 105 in the previous few times. This time it has topped out at 110, 111. Generally, I think the dollar index is breaking down as we see it. It's broken down its 50 and 21 daily moving average. And if it's capping at 110, the peaks and troughs that it's create resembles the Nifty move correspondingly or inversely. So to that extent, I think if it's topping out, there is a good chance that Nifty is bottoming out and it might show some amount of strength and resilience going forward. And last but not the least, I think what we're seeing at Markets with India in terms of our own parameters, how we map distribution days as an example, and gauging how market bottoms can traditionally be formed. 22,725, the recent lows, the market has defended that over the last few days. It has got into a rally attempt as we speak. And as Kunal was just mentioning, we do get a follow through day as we see it at Markets with India, 1.5% move on the index over the next few days. You might have a potential bottom in place. There will be volatility. There is no two ways about it. And therefore, our approach is that be a little bit more cautious, focus on rural sectors because that's what being thrown up in terms of our sectoral rotation graphs as we see at Markets with India.
Mayuresh, one can't time it to the T, obviously. So what is it that you would be gearing up to buy whenever you feel we're getting close to a bottom?
Afternoon, Aisha. Sorry, I couldn't hear you before. So two things, I think. One, in terms of the expectations of rural coming back very, very strongly. You've seen a good Rabi harvest come through. There is expectations of La Nina conditions brewing, and therefore I think the expectation of a good Kharif season expected to come through, followed by the better Rabi season next year around, will mean that the rural recovery will be well and truly on. I think multiple ways to play this, but at least at this juncture, agrochemicals as a space is something that we are probably looking at very, very closely. Stocks like Coromandel International are part and parcel of our model portfolio as a clear disclaimer. Our take is that volumes should significantly pick up. Farm gate prices have remained extremely strong and stable. Input costs, because a large part of their backward integrated operations are largely proving out to be beneficial as far as margin performance is concerned. And the factors in terms of the outstanding subsidies coming off with a relatively better balance sheet compared to its peers, tend us to believe that the earnings momentum might continue. In terms of the technical parameters, EPS, RS ratings, institution holding, they seem to be in a very, very strong footing. So I think this space, Coromandel is something that we continue liking. The other element, obviously, is a few of these hospital stocks, which probably lie on our radar as well. Because here, again, our belief is that the consistency in numbers delivery might very well continue. You've probably seen stable numbers come through from a whole host of players within the spaces itself. And therefore, I think with the bed additions that a large part of this universe is probably doing, an asset-light model that they're probably following at this juncture, the average revenue per operating bed, the average length of stay, the key parameters should start showing signs of improvement as a lot of these new centers start approaching maturity in the next few quarters, leading to better ROEs and ROCs as we see it at Markets with it. Again, I think the EPS RS rating look extremely fine. Max Healthcare, KIMS, something on our radar as well. Last but not the least, we are also being a bit constructive on financials as a space, because what we probably expected to see because of market volatility, the deposit accretion might remain steady and stable going forward. Banks have clearly have their focus in terms of CASA accretion, and specifically with depleting CASAs over the last few quarters, would mean that deposit growth as it comes through would reflect positively in terms of advanced deposit ratios. Cost to income ratios are looking very, very stable as we speak. And therefore, as quality pressures coming off, lending to better return ratios, ROAs and ROEs, seem to be a plausible case. Again, it's a consensus that a lot of people on the street have, but this sector might actually do well in FY25. So larger names like a Kotak Bank probably just stands out at this juncture within the mid-cap names. Karuri Vysya Bank is something we'll continue holding in our portfolio.
Some of the sectors in the stocks that Mayuresh finds pretty attractive at this point in time. But on that note, we'll slip into a break on this edition of Closing Trades. More on the markets on the other side. Don't go anywhere. Welcome back. You're watching Closing Trades on ET Now. Let's continue with our conversation with our experts. We have Naresh, Kunal as well as Mayuresh on the show. Mayuresh, let me come back to you. Just while we're slipping into the break, you did speak about the fact about financials and how you are liking especially large cap financials. But if you look at the way how the FII selling has happened through so far in 2025, most of it has been from the financial segment. Do you think that given the fact that you are seeing that sort of easing out of the valuations, that also could be one of the reasons why financials will do well?
So two aspects. One, I think in terms of the core portfolio itself, The expectations in terms of financials expected to do well is based on a couple of percents. One, obviously, I think the deposit growth should normalize, which was the biggest concern for the entire system. And as this normalizes, the expectations in terms of more stability happening in advances growth reflected through the credit deposit ratio should be relatively better as we head into the next financial year. Obviously, I think the interest rate cut cycle might get delayed and deferred because of the data points that we are getting out of the US, and because one has to maintain parity between the US treasury rate and the Indian rate as well. You're probably expected to see our rates also getting deferred. That might just have some element of impact as far as the overall cost of borrowing is concerned. But it is also beneficial to an angle, because if the rates start going down, I think the deposits rates might start going down as well significantly. And that might again hamper the entire ecosystem in terms of garnering more deposits. The third element, obviously, is that the riskier asset base and the risk-weighted assets to the overall assets itself are very much under control. I think what the regulator has done and RBI's moves in terms of unsecured loans, in terms of personal loans being curbed to a large extent, will mean that asset quality pressures, restructured assets, and slippages should be relatively lower. And therefore, I think the base case scenario is that earnings should probably start picking up in the first half and significantly in the second half. Valuations are not too expensive as well. And as we see the structures, including the rating and rankings that we have at Markets of India, as I mentioned, banks like Kotak Mahindra Bank on the larger private sector space, banks like a Bank of Baroda is shaping up very, very well. And Karur Vysya Bank within the private space in the mid-sized banks actually might post a reasonable set of numbers going forward as well.
Power, clearly that seems to be the leading sector today. So be it in NHPC, which is holding up 6%, there's NTPC higher for 2 consecutive days, there's a JSW Energy, Tata Power. These are all names which are looking strong. Power Grid as well, holding up about 1% odd, CESC, SJVN. The entire energy theme is what is actually taking over today. Naresh, anything that's looking good from within the power names?
So first is if you look at NTPC, which has started making a bottom at 300 and moving up, so that is one which could continue towards 350. Second could be Power Grid, which has again corrected a lot and is making a base around 255, 260. And finally, JSW Energy, which has seen the largest drop in the segment, that could also do well from current levels.
All right, so those are the picks coming in from the power space for Naresh. By Samit Varthak, he believes that to play the power theme, he's playing it via the power financiers. And why does he feel that they are the safer bets? Let's hear out his views.
I am betting it through power finance because then it's more, more diversified. Because whether it's renewable, whether it's nuclear, whether it's thermal, any kind of power infrastructure which is built, it can fund the distribution network, it can fund the power generators across the board. You will benefit. Whether if you just bet on a specific play, like whether it's a wind or solar, it completely depends on the regulations. This is much more safer play where the gross NPAs and the net NPAs will almost be zero. They are writing back a lot of provisions they had taken in the past. They're delivering 20% kind of a return on equity as well as 20% kind of a growth overall. And you're getting these companies at 1.2, 1.3 times kind of a multiple. Whereas at the peak in 2012, they were trading at 3.5 times. So reasonably valued. They may have corrected, but these are the opportunities. One has to differentiate between which are the long-term sustainable stories, because India cannot grow without power. So if you are betting on India, you need to find a risk reward plays within power, which will deliver you over the next 3 to 4 years.
Okay, that's the take coming in on power, and Samit Varthak believes that the best way to actually play the theme is via the financiers, PFC, REC namely. But let's get in some closing strategies as well before we move forward and enter into the last half an hour of trade this afternoon. Kunal, what's on your list?
So I'll go with a financial services name. It's a buy on Chola Finance. That's stock which I think is confirming a triangular as well as a flag pattern breakout just about that 200-day moving average. So expecting the stock to get into a swing breakout mode, a 5% upside is what I'm expecting within near term.
Alright, so that's Chora Finance. Closing trades coming in for Kunal. What about you, Nuresh?
So that would be a buy on NMDC. The stock has given a breakout above 67 finally, a double triple bottom done here. So expecting it to go towards 75 in the short term.
Alright, so that's the closing trades coming in from both of our experts. On that note, thank you so much, Mayuresh, for being a part of the show and sharing your views on the various sectors that one can look at in this market.